Next trade we're going to go over is the ambush trade. What time? How am I on time? What? 5 after 5? All right, we got 30 more minutes. All right, ambush trade setup. Ambush trade setup is a pullback trade. So what we're looking for is a point when the price action starts from a low, goes to a high, and then stops. And then what we're looking for is the market to get worse, pull back, so that we can buy that pullback. If you trade index futures and you're losing money, it's probably because you're chasing. Index futures are not marathon runners. They're hurry up, stop, and reverse. They're little sprinters. Hurry up, stop, and reverse. Hurry up, stop, and reverse. They don't trend all day long. Now, today, yes, it gapped up huge and it just kept on going. That's not the norm, all right? Something that trends well, if you're losing money faster than you can burn it on index futures, switch. Get away from them. Number one, if you're trading S&P, trade the Dow. Try that. That might help you, all right? Number two, if the index futures are still eating you alive, try to trade gold, currency futures, agriculture products, or bonds. Any of those. Those all right there trend a lot better than index futures. Index futures are just choppy in nature. You have the best traders in the world, and you're trading against little kids with Nintendo controllers that are going in and out of the market all day long. I'm not joking at all. I mean, they have Nintendo controllers or Xbox controllers going in and out at 200 at a time. And you just can't compete with the S&P in that type of situation, so try to get away from the S&P if you can. There's other markets out there that are a lot easier to trade and you could potentially be more profitable on. But index futures in a whole eat up a lot of people. This is one trade setup that's pretty good. Just have to have patience to make it work. So it works on the long side and the short side. So let's go through an example really quick. So this is the open in the Dow, and the Dow opens up and runs and puts in a high here at 13,575. So we draw our fib from point 1 to point 2, and we want it to pull back to 50% of that. So at 13,524, then I'll place an order ahead of time at 13,523, okay? So I'll have a standing order right here waiting on it. The start of the buying, into the buying, and then I place an order, boom, here to come get filled. For me, I use a 20-point stop loss, and I just scale out of this thing. If you're apprehensive or you're scared or skittish about jumping in on an order on a pullback, because heads up, the market's going to look great when it's going up. Boy, it's going to look like shit when it has to pull back here. I mean, it's going to look bad, and you're going to have to buy it. All right? You're going to be going, no, that looks really bad. I don't want to do that. But in order for it to go from this high point here and come and get you, things are going to look bad. Okay? So just don't freak out. That's what that stops for. All right? So here's another example. Oh, well, here's where we zoom in. If you don't like having a staged order just ready, waiting to get long, you can zoom in. So what we're doing is we're zooming in here. And what you can see is you can then use either a close above the high of the low bar. You can use that little entry technique we were talking about with tick hooks, where you can just wait for the ticks to start hooking up again. That'll give you an indication that price action is starting to move higher. All right? So a close above the high of the low bar. Here's how that works. So in your zone, in your ambush zone, which is right here, if you're afraid to go ahead and place an order at 13,522, then what you do is you look at the low in that zone, you mark the low, and then you mark the high of the low bar. As soon as you get a bar that closes above the high of the low bar, then you enter. Okay? 20-point stop loss, and then just gently scale out of your trade. All right? Now, earlier I said you'll never go broke taking a profit was one of the biggest bullshit lies that Wall Street tries to teach you, right? True. You always want to add to winners, not in index futures, and especially not intraday. It will take your money. Intraday index futures, scale out of. Okay? If you're going to swing trade them, fine. Add to them, pyramid into them. That's all good and great and all. But index futures, they'll run, stop, and reverse. They're just real wiggly. So when you're day trading, it's a different tactic than when you're swing trading. When swing trading, add it to it, add to it, add to it. Gold, bonds, crude. Crude's like the index futures. So if you trade index futures, stay away from crude. Those two creatures are nuts. All right? Stay away from those. So here's another example of an ambush trade where you've got, you got it? All right. So here's another example of an ambush trade. The best ones look like H's. So in other words, you've got a high mark here. It sells off. It stops going lower. It retraces up. Boom, we short it here, and we gently scale out of our position. All right? So does this qualify as an ambush trade? From point 1 to point 2, point 3. Yes or no? Yes. Yeah. All right, well, it's close enough. Like you have, there's different versions of ambushes. There's major ambushes from the dead low to the dead high, and then there's minor ambushes where you have these little moves from this thrusty move to this thrusty move, and you can actually buy that. So that one qualifies. Does this one qualify from this low to this high to here? Doesn't really qualify because it never goes lower than 13,321, and it needs to actually hit 13,320 in order for it to qualify as an ambush. This is the type of stuff that you have to make detailed notes on before the trade gets there. If you don't, you end up making the bad decision, and you end up getting in the wrong time, and then it ends up costing you. Does this one qualify as an ambush? Yes or no? This one, yes and no. It depends on if you're going to let an execution below the 618 keep you out or not. Okay? Like for me personally, I will go ahead and have an order standing here. For some people, if it retraces back below the 61.8% retracement, they just call it off. They go, I'm not doing it. All right? Question? Do I take what? No, I don't even listen to the news. I couldn't tell you what happens in the world. Most of my friends have to tell me like what's going on. The question is, do you take news into consideration? I do not. I would highly recommend everybody in the room go on like a news fast for like 30 days. You'd be surprised how much money it'll make you. Most of the time, you listen to news and you're like, oh, the economy's in the shitter. That's great. Market continues to go up. Global economic, that's good. Gold's doing 1,300. I mean, as soon as gold starts dropping, there's going to be some news out about it, but we don't really care as traders. You really don't care why it's happening. You just want to know that's happening. I don't care. As long as it's not some major economic news announcement and I'm getting ready to go in, yeah, I'll say, okay, I'll wait 5 minutes, let the number work its way into the market, then I'll trade. Yeah, exactly, yeah. What was the question? Major economic news is, I use a calendar called Econoday, which tells you the major news announcements like Fed announcement, PMI, CPI. Yeah, kind of like same calendar. Yeah, they mainly mark them with a red dot or a yellow dot, so yeah. Yeah, exactly. Any other questions? Me personally, I would get in at 13,349. Yeah, I would get stopped down and lose money on the trade, but I would be in right here. I don't mess around with it. Yeah, I don't. First off, I don't know anything. I don't know if it's going to work or not. I just know I have to place the order and get filled. I know not guts. The trade setup is if it hits 13,349, I'm in it. Whether it works or whether it does not work, I'm in it. Well, I mean, usually for a classical ambush, you want it to retrace at least to a 50%, but you don't want it to retrace deeper than the 61.8% retracement, because then the likelihood of it retracing 100% is really high. So some people will use this as a fudge factor and go, okay, if it retraces here, but if it doesn't retrace here, then I'll get in. I'm not like that. What I'll do is, if it retraces 50%, I'm in. With a 20-point stop loss, I could care less if I lose the money or not. Yeah. Question in the back? No, I just get stopped out and lose money on that one. Yeah, I do. I'll just move it. So I'll just sit there and look. Okay, there's the low. There was the high. This one actually worked. Look at this one right here. From the low here to that high, this retracement, that one worked, right? And then from the low to here, that one never ever had an entry. And then from the low to the high, that one worked, but I lost money on it. So I just keep adjusting them real time. I don't really keep percentage win-losses on each individual setups anymore. I used to. Now all I do is go, is it making me money or is it losing me money? I know people that are right 30% of the time on their trade setups, and they make a gazillion dollars more than I do. So don't get seduced in, does that work 62% of the time or does it work 22% of the time? A lot of people like do it, especially when you're new into the business. Everybody wants like, I want to know something that works like 80% of the time. It's not going to always work 80% of the time. The market is going to evolve over time. That thing's going to start working 12% of the time. Okay, nothing that works all the time across all markets. So you have to be willing to adjust your parameters and stuff. So good question. All right, so